So today I'm going to teach you how to figure out how much home you can afford using a VA home loan. And we'll look at 50K, 70K, and 100K salaries so that by the end you will know your price range and the payment. So let's get started. So VA home loans are a benefit for veterans, active service military, and certain surviving spouses. And they're one of the most powerful mortgage options out there because number one, there's no down payment that's required, so you don't have to save up thousands. There's also no monthly mortgage insurance, which can save you hundreds of dollars per month when compared with going to FHA or conventional loans. There's also a lot more flexible credit and guidelines when it comes to their debt to income ratios. And even though there's closing costs, you can actually have the seller to cover all your closing costs. And this is actually the strategy that one of my clients used when using his VA home loan. He didn't have a down payment and the seller covered all of his closing costs. So he literally bought a house with zero out-of-pocket expenses, cash to close. Now let's go over what lenders look for. So here's what lenders look at. So number one, they look at your total monthly income, and this is going to be pre-tax. So before the take-home pay, they're also going to look at all of your monthly debt. This is going to be like your car payments, credit cards, student loans, if you have any child support, alimony, anything that could come up on your actual credit report, and they take the monthly payment of that. And then the formula that they use to determine is called your debt to income ratio, which basically just gives them an idea of how much of your monthly income goes towards your monthly debt. And VA, they will allow up to 60% of your monthly income to go towards your monthly debt. And then also interest rate does play a part in home affordability because when interest rates were super low, you could qualify for a lot more house than opposed to with a higher interest rate, you're not going to get approved for as much. So if using a $50,000 of yearly income, here's how the banks calculate how much home you can afford. So number one, they're going to take your monthly income, which in this example is going to be $4,167. And again, this is pre-tax, this is not after taxes. Then they're going to take your monthly income, multiply that by 60% because they'll allow 60% of your monthly income to go towards your monthly debt, and that will give you $2,500. Now this number is the max amount of all of your monthly debts can combine, including the future mortgage payment. So then we take that number minus all of your monthly debts combined. This is going to be your car payments, credit card bills, things like that. Then that will give you $1,500. Now this is going to be the max mortgage payment that you can qualify for, which is going to put you in a home price of around $200 to $210 purchase price. Now again, if you had a little bit less monthly debt, that's going to help increase your buying power. Now let's go over $70,000 of yearly income. So with a $70,000 of yearly income, here's how to calculate it. So you're first going to take your monthly income. This is pre-tax, which is going to be $5,833. You're going to take your monthly income, multiply it by 60% because this is how much VA allows of your monthly income to go towards your monthly debt. And 60% of this number is $3,500. Then you're going to take $3,500 and subtract any of your total monthly debt. In this example, we're using $1,000 of monthly debt, and that's going to give you $2,500. Now, this is going to be the max mortgage payment that you can get approved for, which is going to be around $350 to $375 purchase price. Now let's go over 100K annual salary. So here's the breakdown. If you make 100K per year, so your monthly income is going to be $8,333, and this is pre-tax, so before taxes are taken out. Then you're going to take that number, you're going to multiply it by 60%, which is the max debt to income ratio that VA will allow. And that means that 60%, they'll allow 60% of this number to go towards all of your monthly debt, which in this scenario is $5,000. So you're going to take that number and subtract it by all of your total monthly debts combined. In this example, we're using $1,000 of monthly debt, and that's going to give you $4,000. So this is going to be the max mortgage payment that you can qualify for, which is going to put you around a $550 to $575 purchase price of a home. So these examples we just went over are really just estimate, and there's a lot of variables when it comes to putting together these scenarios. So here's what can change. So number one, if you have a higher amount of monthly debt, that's going to decrease the amount of buying power that you have or how much you qualify for. Also, the interest rate impacts it as well because the lower interest rates are, this will allow you to qualify for a lot more. And this is why a lot of people were very surprised when they got pre-approved several years ago when rates were 2 and 3%. They ended up not buying. Then they get shocked at how much lower their pre-approval is with today's rates because the interest rates are higher, which cause the mortgage payment to be a lot higher as well. And also, location plays a big factor in this, because if you live in an area that has a very high property tax, very high home insurance rate, that's going to increase the mortgage payment, which also can decrease the amount that you qualify for. Also, the more income that you bring, the higher your buying power is going to be. Now let's go over the different types of income that VA allows. So VA allows you to count more income than compared to other loans, as long as it's stabled and can be verified. So you can use your main job, base salary, you can use hourly, you can use disability, social security, any retirement income. You can also use military income as well. You can use any overtime and bonus. And also, if you are self-employed, they'll need your 2 years of tax returns, but you can use that as well. So you want to get pre-approved about 3 months before you actually need to buy a house, and you also don't want to max out your pre-approval, because just because the banks qualify you for that amount doesn't mean that it's a smart financial decision for you to max out that pre-approval. So typically they say a good budgeting tips is you want to keep your mortgage payment to about 25 to 30% of your monthly income, and that will help keep you on a good monthly budget. Now, if you're planning to buy a house and you want to know exactly how much your buying power is, click on the link in the description, schedule a call, and I'll be in touch.